uh, knowledge sharing from Mehta Mehta. And yeah, today's topic is we have decided to have it's a presentation on this decoding accounts and financial statement with specific reference to the amendment in Schedule 3 of Companies Act. So this will be divided into two sessions. So today will be the first session, and probably next Saturday we'll take it up the second section. So next Saturday we'll take it up the amendments in the Schedule 3. So friends, just to introduce our today's faculty, we are very privileged to have a chartered accountant, Madam Ranganayaki. She's a practicing chartered accountant. She has multiple qualifications, to name few: chartered accountant, company secretary, cost accountant, so all triplets. She's also insolvency professional, registered valuer, and certified independent directors, from IICA. And of course, he has obtained some GST, the certificate from the IICA. And of course, he comes with 20 years of vast experience. He has worked with a group like Oswald Group, RPG Group, Elecan Group, General and Atlantic Partners, ILX Media Group, and EGS Group. And she has handled various senior level independent role, and she has handled the various aspects of the business, including project implementations, fundraising, direct tax, indirect tax planning and assessment, then FEMA compliance, FIPP, and there are many more. So beside working in the corporate world, she's very active in mentoring the students. So she's a regular speaker in CACS and cost accountancy. She also conducts various workshops on the GST and the tax compliance, and she is a trainer in the finance for the non-finance professionals and the independent women directors in companies. So we welcome Rama to this webinars. Rama, no, we are doing this webinars, for almost last 1 year constantly without any break. And now we also have another panelist, our senior member, our own member, Mr. Bala. Mr. Bala also doesn't require, because he's there in all of our webinars. So we called him as a Professor Bala. He's a regular writer in the on a company law related matters, and I can see every week he writes some articles in the magazines. And he's also comes with a very rich experience, 30 years of experience. And he has worked with a multinational company like Foseco India and virtually handle, all aspect of the business, right from the finance, account, legal, compliance, everything. So thanks, Mr. Bala, with us. And I can see many of my friends, who are joined, Mr. Jagdish, and I can see Ashish Nandade also. And yeah, many of my friends has been. So welcome you, madam, to this webinars. It's more of a learning. It's more of an interactive, and you can have a presentations, and whenever there is a questions in the chat box, I would request those participants to put their questions in the chat box. So Mr. Bala, at appropriate time, will take up this case. So Mr. Bala, to you. Yeah.
Good morning to all of you. By and large, what happens is company secretary, although they are the signatory to the financial statements, we don't get involved much on the financial statements. Somehow we are restricted to our area of, only Companies Act, related compliances and board report, governance report, etc. and other things. But equally, it is very important, especially whatever the development which has actually taken place over the past so many years on the accounting field. Because basically we moved from accounting standard to international financial reporting standards. And then all our accounting standards have been actually converted into Indian accounting standard Indies, which is actually convergence with the international accounting standards. And again, if you all remember, about a decade back, after the Enron debacles and one of the big four, Arthur Andersen, vanishing from the sign, our Chartered Accounting Institute has taken a big leap. And when we had only around 10 accounting standard, they have introduced many more accounting standards. Accounting standards now beyond 35 today. and coupled with a lot of guidance notes, etc., which has actually come. Everything actually comes in the transparent and the better disclosure. Because financial statements are the one which actually gives the real measurement of the company's progress, which has been made from year after year. Like in our school days, college days, we used to get the progress report, what has been done in the past 1 year. Similarly, the directors, they actually present like a progress report, what is the company has done in the past, what is it compared to the last year, are we better, are we worse, whatever the things are, appropriate disclosures, how the matters is dealt with, what are the things, along with the threats and also opportunity which are actually available. Because the whole idea of presenting all these things are to enable the investors, shareholders, and whoever associated with the company, maybe debtors, creditors, etc., to take an appropriate decision. It is actually aiming towards the appropriate decision-making processes, and it is a better disclosure, which is demand of the day. And again, the comparability, because today we are all becoming a global village, the comparability becomes very aspects. Nowadays, more of the foreign direct investments are flowing inside our country. So in which they would like to see the company, its comparability, its disclosure, etc. and other things. From that point of view, it acquires very, very important. As Atul has said very recently, there have been a lot of amendments for the Companies Act regarding to balance sheet, profit and loss account, cash flow, etc. And plus, from the listing agreement side, there have been a lot of disclosure requirement which has been actually demanded. Many of you may be aware, we discussed some of the issues in the past also. One is business responsibility report, which has been actually enhanced to business report responsibility and sustainability report. Where what happens is there are a lot of disclosure which have been made. So here, what are the basis on which these disclosures are being made? That is what it is actually coming into. Whether it is in line with the accounting standard, what is the company's policy, how we are actually making it. Not only the financial disclosure, also non-financial disclosures. These are all some of the things. And very recently, when we talked about the financial statements, financial statement, what is understood in the common parlor is balance sheet, profit and loss account, and cash flow. Now, recently, you all might have seen the small company definition has been actually amended. There are companies which have been given exemption from complying with the requirement of cash flow statement and also the CORO reporting, etc., and all the things, which is the latest development to give relief to the smaller companies and medium companies, etc., and other things. So there are so many integrities and nitty-gritties which are actually involved. As Atul puts it, Ranganayaki is one of the veteran, really speaking. I am also going to listen to her first time. I happen to go through her presentation, which is actually sent to me. I must tell you, friends, there is no word beyond excellent, excellent, excellent. The way in which she has actually prepared the presentation excellently, eye-catching, which will actually capture your mind, what is there. Definitely, we all will be highly learning today, and we will get the better understanding, better knowledge. In my opinion, we should actually get to be involved in the other aspects of the thing, because we call ourselves corporate law experts. We are no more only a company law expert. We are the corporate law experts. We are studying most of the corporate laws ourselves. That is the reason. So I think over to Ranganayaki. Can I have a few words on this before you start the presentation, madam?
Yes, sir. Thank you very much for the warm introduction, Atulji and sir. I think, you put a lot of pressure on me. It's a very simple presentation I've made. I will try to do it. Today's session will be first 20 slides will be on the basics of accounts, because, time and again, when we go to a CS forum, they say, why should we read the balance sheet and P&L? It's a job of the auditor. So, I put one slide to say why we should read it and what are the implications coming out of not reading the balance sheet and profit and loss account statement. As you mentioned, this is the scorecard. Our child comes with a progress report and we don't know whether rank 1 is good or rank 10 is good. How will we ascertain what's happening in our boards? So with this basic, I can get into the presentation. So, but financial statement analysis is very, very important. More so with the amendments in the Companies Act, which has come from 1st April 21, the balance sheet which we are preparing, you find ratio analysis there. You find, a lot of implications on defined companies, strike-off companies. So there's a lot of synergy between company secretary's work and the chartered accountant's work. We have to work in tandem and check and ensure that data is matching. And there's a lot of synergy for the work done so that we can get a best corporate governance coming out of all our reporting.
Thank you, madam. Let us start the presentation.
Yes, sir. I'll just share the screen. Yeah. Today's topic we are going to cover in 2 sessions. The first part is reading of financial statement. Schedule 3 amendments, which we'll do it in the next session. And ratio analysis will have a part of this session. So basically, we will do the reading of the financial statement and each and element of financial statement, how it has got relevance to a company secretary, whether we are a KMP, whether we are a secretarial auditor, or we are in the compliance management. And what are the implications of these in our profession or altogether in the entire professional corporate professional's life? So before getting into that, the question of why we need to read anything or understand anything. So as sir mentioned in the beginning only, as a KMP, we are the people who are going to sign the balance sheet. Unless until we know what exactly we are signing, we cannot be held responsible. So because if we have signed something unknowingly or not looking into that or understanding the implication, we are going to be responsible. KMP is the first person who's going to be responsible for all the activities. So company secretary being one of the compliance keeper, it is our ultimate responsibility to know every comma and full stop in the balance sheet and P&L to be understood, because we have to read with a disclaimer. When the auditor gives his or her report, they say they have audited only the balance sheet and P&L. Those numbers they've ascertained. But there are a lot of information which is given in your director's report, in your management analysis, which is not confirmed by the auditor. It is given by the management. As a KMP, we should know what exactly is in those numbers. Are those numbers making sense to us at the first instance? And tomorrow we'll be able to justify those numbers is a first requirement. As a consultant, we all want to grow our practice. We all want to get into various areas of practice. So compliance management is one basic area of our practice. And without understanding these numbers or the number of statements, it will not be possible for us to do a compliance, help in the compliance management. Secretarial auditor, certifying your AOC4, MGT7, these are all our day in, day out practices. And there we are certifying those numbers. Those numbers, if it doesn't make sense to us, or we are blindly certifying those numbers, is going to cast a huge responsibility and liability on us. If you read all these, leave all the 3 points. If not, we learn it today. When will we learn it? Today is a day of knowledge. Without reading every day, it is impossible to do any practice. Knowledge.
As you rightly said, company secretary is named as a compliance officer of the company. He is not the compliance officer only for the Companies Act. And not only that, after the company's new law, which has come into existence in 2013, makes it very clearly the functions of the company secretary. It says very clearly the company secretary has to ensure the board complies with all the applicable laws to the company. So in which case, including the accounting standard, including the statement, including the financials, everything, financial and non-financial, as you rightly puts it, is applicable to the company secretary. Because company secretary is ultimately going to be responsible. He is termed the compliance officer under the LODR, and he is termed as a compliance officer and the principal officer, even officer in default. That is the significance of company secretary, what you are talking. Is that correct?
Yeah, absolutely correct, sir. Yeah. Let's answer one more question to our audience. Why we are reading under company law session? I'm a corporate law professional. Yes, we are the the custodian of Companies Act. The Companies Act itself has got chapters talking about accounts, audit, and things like that. So it is our prime responsibility to know what we are talking about. So chapter 9 talks about accounts of companies. Chapter 10 talks about accounts and audit and auditors. Schedule 2 talks about depreciation, how to compute it, what rates to be applied, what years to be applied. And 3 talks about how it is to be presented. So we have to learn. There's no choice. So let's get quickly into the relevant sections. We go to the basic section, section 212, which talks about books and paper. So it includes your, so we are concentrating on minutes, registered and electronic form. But it talks about, books of account, deeds, vouchers, and writings. All these things are part of our responsibility, though the work may be, delegated to responsible people. We always see in management, the authority can be delegated, but responsibility cannot be. So ultimately the responsibility comes on to us. And books of account talks about, money received, expended by the company, sales and purchases. So every element of your financial statement, be it your asset, liability, purchase or sales, if it is undercasted or overcasted, it's going to have a huge implications on the financial numbers. Sometimes it could vitiate the going concern of the company. Recently, we just saw one NEFRA, report barring a chartered accountant for 3 years because the borrowing cost was not provided. The logic given is once an account becomes NPA, bank doesn't charge, financial institution doesn't charge, and hence it is not provided. But non-provision, not bringing into light, is made the balance sheet go hayway, your financials go hayway. So that's where a proper disclosure and a true and fair view book is very important. We have to read everything in the context of the current scenario. Now we have NEFRA looking into listed companies. It is looking into certain specified companies having some threshold turnover and capital. So the numbers are looked in deep sense. If you go to NEFRA website, you can see the audit quality report and a financial review reporting quality is available in the website. If you read, Big Four's balance sheets are being challenged. Their reports are being challenged. So there becomes a huge responsibility. It will just take a minute to extend it to all other professions. So we have to be gearing up for what is going to come in the future. So financial year is something we all know, so I don't want to get into that. And then companies account rule says, among other things, provides a manner of keeping books of accounts. So where it is to be kept, who all have an access to inspect those, the finance directors can get extract from it. So this is the basics of Companies Act to understand where and from where we talk about financial statement under the Companies Act. So you have any comments to make?
When you actually talk about the NEFRA, that is National Financial Reporting Authority, they are the independent organization which are specifically established under the Companies Act.
Yes, sir.
To oversee the accounting, auditing profession and also the accounting standard in our country, which is actually in convergence with the accounting standards in the entire globe. That is the way it is actually there. As you rightly said, if we look at it, section 132 of the Companies Act, which actually deals the various references of the NEFRA, actually, we can actually find it, etc. So that is the importance of the things. So really speaking, as you rightly put it very clearly, we have to learn accounts, financial statements, what we are signing, what is being disclosed, etc., and other thing at all. In fact, I have seen there are a lot of companies which have actually received not disclosing certain information. For example, segment reporting. Company is silent about it. They got the so-called notices issued. You are not talking about segment, whether your company is under segment or no segment. If it is no segment, it has to be mentioned specifically. The segment is operating only one segment. That is the extent the regulators actually now going into the detail today. That's it.
In fact, to add to that, a couple of days before there was a circulation in WhatsApp saying that, for not mentioning DIN number, there's been penalty posted on the company and the directors. So
yeah, it is right. In fact, I have a case very recently. It is decided. You know how much is the amount is fined? Around 6 lakh rupees of 2 of the companies. We got 2 of the companies have gone for merger, yeah. And both the companies have not mentioned the DIN number. So there were 3 directors in each of the company, and the company was charged 2 lakh rupees, and each of the company charged directly 1.5 rupees, 6 lakh rupees they have to sell out in both the companies. That is what it has happened in that. Not only that, even there has been issues where not mentioning the SIN number actually.
Yes, sir.
Even that, there also the cases are there actually. Really, these are all the very nitty-gritty. We are just thinking, oh, it is a small typographical error we missed out. That is not the issue. It triggers the serious compliances issue. And another thing is there, as you rightly said, it is all required to be disclosure ultimately in the report. Because there is a specific columns in the annual return. What are the various show cause notices, cases, etc., which is actually decided, which authority, what is the section, what is the relevance, how much amount, appeal is pending, non-appeal is pending, what is it, all the disclosure which comes. As I said in the beginning, it is a progress report. When you look at the progress report, these are all going against the company as a black mark. Company's reputation is involved.
In fact, the financial statements have to, we think certain things are okay. Now, I just wanted to mention, before we never had the CSE, Central Scrutiny Center. Now that is coming in place. They are picking up the data, they are scrutinizing it, and they are sending it to the respective ROCs to take necessary action. And they have a window of 8 years. So there is a huge pipeline for us to wait and see, if anything has gone wrong in the past. So with that, let's get into need to know finance. So now we have understood why under Companies Act. Now we need to know why finance and financial statements. We are the KMP. Yes, sir.
Rama, I just wanted to request you if you can just make this, full screen, because there are people who are, seeing from their mobile phones.
Yeah, I've done that, sir. So, we are the KMP. We are sitting in the board, understanding the pulse of the board, what they are saying, we are minuting it. So unless and until we understand what board thinks, what they understand, and what they want to communicate, we will not be in a position to even to write a normal minutes of what they have said. So in board, it is full of, yes, sir.
There's one question has come, can books of account be kept at one place and secretarial records in the another place? Really speaking, it's not required to be kept at the register of this place first thing, but the law permits. You can have one more place where the books can be kept actually. If the company is having a different place where the accounting is being done, you can actually declare. And there can be another place where it can be actually kept. There are many companies which are actually doing it. For your information, Vodafone group of companies, they are having a register office actually in Bombay, and their books of accounts are actually kept in Ahmedabad. They have categorically disclosed, it is appearing. If you open any of the Vodafone group companies website at the MCA, it is written register office. Other place are keeping the books of accounts is Ahmedabad office. It's appearing, that can be done. Yeah.
So board is a place where strategic decisions are taken and strategic, key parameters are set in. So what they talk, what key parameters they are talking, we need to understand. So as sir said, progress report. This is the financial statements are the progress report. Unless and until a parent understands first rank is a good rank, or the last in the class is a good rank, is it on the order of ascending or descending, it will not be possible to understand. It is a scorecard, and we need to understand how the scorecard is prepared and what are the good numbers. The scorecard can be compared inter-firm and intra-firm. So unless until we understand the scorecard, it is not possible to do an inter-firm and intra-firm comparison. And again, helps in setting long-term financial goals, ratio analysis. I just said inter-firm and intra-firm comparison. My own organization's performance over a period of 10 years, is it on the growth trajectory, or is it flat, or it is going on the declining scale? In the industry, my market share was 20% 5 years before. Is it gone up to 50, or I've gone down to 5%? These things can be understood only when we see the financial statement and understand the financial statement. The very important thing which will come from a financial statement is the red flag items. Some numbers will see, the numbers can lie, but when you take the ratios and analysis or a cash flow statement, they cannot lie. So we should be able to identify the red flag items from the financial statements if we read the statement in detail. Now, if you see the latest amendment in Schedule 3, they have asked to put in ratio analysis, because ratio analysis cannot lie. Cash flow statement cannot lie. The numbers can be cooked, but these two things will really give you a sense, because there is no sales. There is no sale increase in the last few years. My profitability is gone up. What is the reason? Has there a cost cutting? Or has there been any other specific one-time revenue which has been recognized? All this information can be identified. So once we understand the financial statement, the red flag items can be, I won't say easily, but it can be noticed if we get it right.
Not only that, when you are actually talking are we in the loss-making situation or profit-making situation, company PV extremely in a profit-making situation. They'll be doing extremely good. If you look at the balance sheet and profit loss account, their profit which is shown is actually very high level. But if you look at the company's position in terms of the cash, they are actually very poor. They don't have the cash. In fact, there is no cash is there in their kitty. They are unable to even meet some of the important requirements. Why that is happening? Because whatever the sale they have affected, everything is actually sitting with their receivables. If you open the balance sheet, it will be appearing trade receivables. Money is actually sitting there. Unless the money is actually getting converted in the bank account, it comes into your kitty, you don't have money at all. So what happens is money is lying there, but you are doing a business for somebody else. You keep on borrowing, you pay on paying the interest, and you are not able to meet your requirement. That is another situation which actually comes. So really the turnover receivables is very important ratio, which actually tells you in how much time you actually make the payment to your supplier and how much time you actually get recovered money from the customer, whether the cycle is actually comparable, meet each other, it is compatible. That is another important issue based on which the business decisions are taking. The crucial decisions. That is why many companies comes out. We offer a discount if we make a cash payment, if we give you the concession, we give the long-term discussion, etc. Because in order to increase the cash receivable position. That is another issue which is actually coming out very clearly from the point of the business making decision. These are the indicators.
In fact, last year it would have been difficult for us to identify whether they were turning their stock into cash or not. Now with the ratios, it is quite obvious for us to read. And job of analyst is already done by the company and given to all the stakeholders in the financials. So it becomes easy for anybody to read the statement and make a decision.
Yeah, absolutely right.
So get the right kind of capital and debt mix. When we talk about finance, there is called a leverage effect. By having a debt, I can increase my shareholders, earnings. I can increase their value. So what is the right kind of debt and equity which I can bring in so that by adding in certain debt, I'm able to get leverage for my shareholders. So that kind of right kind of debt and equity structure has to be brought in. Those things can come only from the financial numbers, only when you look at your borrowing cost, how you are able to get the money. All these things can be got from the financial statement. Share repurchase, whether by keeping the shareholders' funds with me, am I adding value to them, or am I stagnating their value or deteriorating their value? Again, those information can come only when we find to understand the financial statement. So we have adequate reasons why we should be able to read the financial statement. Then we said good strategic plan includes metrics. So all these metrics are the vision and mission statement of the board. So board CS works with the board. So we should know what vision and mission statement, the profitability, the free cash flow, tax optimization, economic value. See, end of the day, if the organization is not able to do economic value addition, there is no sense in doing a business. So are they doing economic value addition and risk assessment in its implication? Compliance and corporate governance comes but naturally for a company secretary. But the first 4 parts is something we need to work, because sitting in the board, you get competence enough to head the organizations. We have seen chartered accountants leading the organization in P&L functions, but we see very rare company secretary getting in that. But by sitting in the board, possibly a chartered accountant will enter the board meeting only for the the areas where the financials are discussed. But a company secretary sits from the beginning of the meeting to the end of the meeting. We get the entire crux of the meeting. So we should be able to enhance our knowledge and get value addition in our business. This is something I don't have to talk about it also. What is there in the financial accounts and reporting? We have the profit and loss statement, balance sheet, notes to accounts, director's report, independent auditor's report, and cash flow statement. Profit and loss and balance sheet is fine. Director's report we prepare, so no problem. Independent auditor's report comes to us. Cash flow statement, sometimes we don't even look into that. What is there in that? Notes to accounts. The devil lies in the detail. The devil is in the notes to accounts and in the cash flow statement. If we read the notes to accounts, we get a ton of information which otherwise we would have missed it. So the explanation of the figures, the policies used, what is different from last year to this time, what is a variation from accounting standard to what I follow, all these things will either give you some insight into what is happening or red flag items as to what is happening. Cash flow statement cannot lie. Our organization can cook up the numbers in the P&L, but how as sir mentioned, how the cash has come, whether the cash has come from the operating activity or from financing activity or from investment activity by selling the assets or by borrowing, then we will know if at the operating cash flow level we are negative and it is being financed through borrowings or by selling of assets. Maybe 1 year, 2 years in the initial years of growth, it is okay. But year on year, if we see there is a negative cash flow in the operating activities, then there is something wrong with the organization. That is the red flag we should get it.
Apart from the listed companies, in most of the unlisted and private companies, the notes accounts, somehow or other, it becomes a sort of a paste and copying what has been there in the past that has been actually taken over and is carried over. In fact, it's a high time for our company secretaries to go into the details, sit with the finance department, and see the notes of accounts reflect the current time. If wherever it is required, they need to modify, they need to bring, they need to do their homework for that, which I had done in a company where I was actually working. So this is required, where our knowledge will definitely get enlarged if we actually get involved in the notes of account, because that is the one which explains each and every figure which is sitting in the balance sheet and the profit and loss account.
And sir, in some cases, you tend to don't even see the accounting policies, how depreciation is accounted, how income is recognized. Those info notes are not even there. So those things have to be very critically taken. And then there are disclosures. What is the remuneration to the auditors? What is the remuneration to the KMP? All these things have to come in the notes to accounts. Earnings in foreign exchange, all these information have to be there as is required in the law.
The reason I also seen some cases, non-disclosure in the notes to accounts regarding the accounting policies, accounting standards followed by the company has actually invited the show cause notices. There have been penalization action which has been taken by the regulator also. Yeah.
And recently we read also saying that, the companies who have just uploaded their tally balance sheet and P&L have got notices for, and initially I thought it could be a joke, but finally I heard from one of the professionals, they have uploaded and they have got all these notices.
That's it is right. That's the case. Yeah.
And all those notices also somewhere it has to be highlighted in the secondary audit report also. I think many of us probably have seen those young PCS, they miss out on this because certain thing notices and all which has been received by the company. Of course, this notice, why? Because some non-compliance. So that's also affect PCS also. Yeah.
And director's report, I don't have to talk about it. It explains the financial performance. The only disclaimer here is many of the numbers and information in the director's report are not the audited numbers, where the auditor himself or herself has given saying that, I am not a party to that. So those numbers have to be with sanctity, their validity has to be checked. So it puts into context the activities, achievements against the plans and objectives, and it outlines the plans for future. With the director's report, POSH compliances, how, whether you have it, that requirement of independent directors, the requirement of environmental compliances, all those statutory requirements have to come in, foreign exchange earnings, outgo, all these information, whether any penalty, prosecution notices have been received in the past 1 year, all those information has to come in as expected in the law. So
this one question has come actually.
Yes, sir.
Some companies prefer not to disclose WTD's remuneration in the balance sheet. This is a scenario that you must have also come across. There is no question of non-disclosure of the salary, because salary has to actually come part and parcel of it. That is the expenses of the company. It has to find the place in actually the profit and loss account. It should come actually under the remuneration details specifically. And second thing is, again, when it's come to the WTD, as a company law requires, the salary has to correspond to 5%, 10%, 11%, whatever the limits are there, how it is computed, calculated, etc. All the disclosure is there. If the disclosure is not there, then definitely it is a violation. The serious action will be taken by the regulators.
In fact, what he is asking will generally happen in a very closely held private limited company, but we need to sensitize the board that this is a requirement of law and there is no waiver to this for that matter. They don't want their personal data to be there in the public domain, but the very purpose of company law is corporate governance and transparency. So if that itself is going to be questioned, then it's difficult.
I don't know today, long time back, apart from the listed companies, for the other companies, the salary remuneration details, beyond the people who are drawing 2 lakh rupees per annum, etc. And
Yes,
all these things used to be disclosed as
yes.
employees' salary details. Earlier, there was a provision, if I remember correctly, company has got an option that this is actually forming part of the accounts. However, it is not actually enclosed as a enclosure, but those people who are interested, they can write to the company secretary and this information will be supplied upon request. That facility was there other than the listed companies. Listed companies anyway has to disclose. That is definitely the case. Today, I do not know whether such a provision is available or something like that. But Not to disclose will not come because the thing is it has to form part of the financial statement in any case. But the only thing is the individual detail is to be disclosed or not. That is what probably the reader is the participant is asking, I believe. Is that correct, Shruti? Are you there?
Yes, it's correct.
Yeah.
So when we look at accounts, the entire basket falls into two heads: income and expenditure. The income minus expenditure is profit, or it is, if it is vice versa, it is loss. Then assets, liabilities, and equity. So this is a basic. I'm not getting into that. Assets is what we own, liabilities is what we owe, and net worth is the the equity or the owner's fund. It could be CCPS, it could be preference. So when I put it equity, I should have used the word owner's funds. So this falls into this particular basket. Your P&L is nothing but income minus expenses. The only difference is the expenses could be something called as direct expenditure, which will vary exactly with your level of operation. When we look at costing, it talks about expenditure into direct cost and indirect cost. What is a direct cost? If I produce 5 units of a product, if my cost is 10, if I produce 10 units, it will be 20. So it exactly varies with the level of my output or the sale. Whereas indirect is something which remains same irrespective of my level of operation. But in indirect also there is something called variable, fixed and semi-variable. So it has got a component of semi-variable. Some part will be variable, some part will be fixed. Ideally, the gross profit talks about income minus cost of goods sold or direct cost. That shows me the gross profit. At an operational level, what is my profitability? From there, if we minus all the direct cost, my interest cost, administrative cost, selling and distribution cost, and all of the fixed costs, we arrive at net profit. That is the, I will just take you to the next slide and discuss in detail. The difference is, I will take you to the very, very basic fundamental of accounting. My team member always makes fun of me. Anybody comes to me for an interview, first question I'll ask is, if it's an accountant, you tell me the golden rule. Because this makes you understand how much we know accounts. So the golden rule of accounting is, we have a personal account which says debit the receiver and credit the giver. Real account calls, debit what comes in and credit what goes out. And nominal account says debit all expenses and losses and credit all incomes and gain. Balance sheet talks about only personal account and real account. What assets we own, what liabilities we have, what is the owner's equity which is available in the business. So at balance sheet level, we are talking about personal account and real account. Nominal account is what which is there in your P&L account, which talks about all our sales, purchases, and incomes and all the other gains. So with this, when we get into the balance sheet, Schedule 3 format says the balance sheet and the P&L is prepared, and the auditor says it gives you the true and fair view. The difference between true and fair view and true and correct view is when we give a tax audit report, we use the terminology true and correct view. That means we certify the accuracy of each and every number. But whereas in a balance sheet and a P&L, it cannot be true and correct view for the simple fact there could be some provisioning not done, there could be something. So it gives a fair view. And again, if you see, if there are any inherent frauds, if there are any things which is not deductible by the system, and auditing will not bring those things to the light. So auditing, an auditor can give only a true fair view of the balance sheet and P&L or the financial statement. He or she cannot give the true and correct view. Whereas in terms of a tax audit report, each and every number is confirmed. It is a true and correct view. The balance sheet.
In fact, we also very often come across what we call window dressing of the accounts. Window dressing of the accounts are done in many ways. But in some of the companies in the early days, I have actually seen myself. What they used to do, they used to get some sort of the incentives based on the sales achieved by the executives. Now, what happened over the period of time, suppose 100 crore sales used to be achieved. Some or other, they have achieved 120 crores. Now, the problem is, what they know, because management accounts are already prepared on the estimated basis, they know what is going to be the figure. So what they do before finalizing the accounts, deliberately, they make a provision for the credit notes likely complaint from the customer, this, that, etc. They reduce the 120 crore sales to something about 102, 105 crores, and the 15 crore sales is kept in the form of the credit notes, which is somehow other managed and explained to the account of people who are auditing in such a way, which in fact is carried over in the next financial year. So next financial year, if I'm falling short of it, these 15 crores will come into my rescue. Which means what happens is, again, that is why the cautious note is always appearing from the auditor's point of view. To the best of the information and disclosure made by the management to us, based on that, our judgment. So now again, the window dressing of this sort of the things calls for very high intelligent level of managing it, which I will put it actually. So in this case, they are not doing any fraud, but the only thing is they are not disclosing the appropriate or correct view in the statement. That is it.
Government of India is catching up with us all this knowledge.
Yeah.
And that is why when you see in GST now, they say the last date to take your input or pass your credit note is 30th of September next year, which have them now this year they have increased to 30th November. So you lose the input credit or you lose the tax credit on that. So now with GST coming in, so now the data sharing is so good. When you said service tax, when you are talking about income, service tax department has sent notices to people for 2015, 16 and all who have crossed their threshold for registration and not taken registration. And only simple MOU between direct tax department and indirect tax department to share the information. Income tax has shared all the data with the service tax department, and they have showed out notices to people who have crossed their turnover of 10 lakhs and not taken registration. And literally Government of India has collected revenue along with interest and penalty. And I'll tell you, if your tax payment is overdue for, or it's not paid for 4 to 5 years, your interest amount is going to be more than your principal amount at 18%, 24% per annum interest. So that's the kind of revenue the government is collecting with data analytics, with artificial information and share of information between the department. So now when you file your income tax return, or anybody who opens a 26AS, you could see all your annual information system, your purchases, your sales, your GST turnover, everything is whether I bought a property, what is the value of the property, what is the TDS on that. So there is an AS information, there is a TIS information, plus you have your 26AS. So all these information has to be correlated when an auditor is doing an auditing exercise.
Not only that, in a future days to come, I'm talking not today, in a little longer term, with the digitalization and the artificial intelligence, which is actually coming to the light, what is going to happen is the future boardrooms will not be conducted without the presence of artificial intelligence is actually present. That is what is going to be there. Because ultimately, at the end of the board meeting, of course, it is a human who are going to take a decision, but the artificial intelligence application will actually tell you who's actually processing the correct data, who's not processing the correct data, who's talking out of the way, who's actually talking only for the sake of talking, what could be right, what could be wrong, where we can trust upon, where cannot be trust upon. All the things are going to be the future of the day. It is going to come. Let me tell you that. That is the day I visualize from today by looking at what is the way the digitalization, the artificial intelligence is taking forward.
In fact,
what is your Atul sir?
Hey, I just wanted to share one thing. I'll tell you, just last month, one of my clients called me and said, Mr. Mehta, I'm getting a call from GST department. I said, why? So he said, see, look, since there was a lot of holidays, in the month of August, so our collection is less, So we told GST people that, look, we are going to file 1 month late and with a penalty, those, interest you pay. Somehow, this guy was after my clients, somebody from GST. He said, see, I'm calling from commissioner office. You pay, otherwise, we'll lock your bank account. See, this is how I said, see, look, I have a facility. I can pay 1 month late also, 2 months late also. But see how these people, they are chasing as if, he has made some crime. And they were just calling every 2-3 hours. आपने pay किया कि नहीं? आपने pay किया कि नहीं?
Sir, you will not believe, day before yesterday on Thursday, I went to submit one reply for a show cause notice on an SSE. The SSE told me in the morning, ma'am, there is a call from the department for the last 10 days. I have not paid my GST from June because I don't have the cash flow and it has not yet come. But he's been asking me, maybe he will ask you. You will not believe, I just went and met the officer. I gave him the show cause notice reply. He first thing asked, this is the client? Where is the tax payment? He was supposed to pay. Menika, sir, yes, he is trying to pay, but problem is cash flow has not been arranged because GST gives 6 months window for you to pay, other failing which it will be blocked. It's only 2 months. He's trying. In fact, he said by Friday evening he'll pay it. Ma'am, I have issued a ASMT 10 for that month. This month, this evening, I'm going to issue it for 1 more month. I said, sir, hold on till tomorrow. He will pay. कहते, ma'am, tax pay करना आपका responsibility. I said, yeah, tax pay करना responsibility है. But मेरे पास पैसा नहीं है तो मैं किधर से pay करूँगी? I said, take an example of a professional like us. We invoice our client. Client may not pay for 1 year, 6 months. But upfront, we have been asked to shell working capital. I said, sir, मजाक में मैंने बोला, sir, हमारी case देखो. We are rendering services. We have not collected the money and I'm taking working capital from my pocket to pay you. So look at this client, he's doing a big business. How is it possible? He laughed at and he said, मैं क्या करूँ? I've been asked to collect. But that's the scenario. That is what government needs to understand. One is you're trying your level best to run business. Now you're going to get working capital for something you're not responsible. Your client is not paid and still you have to pay. So the data is shown, sir. Yesterday, Nirmala Madam has said in one forum, saying that, in listed companies, I'm seeing the directors repeated in almost 7-8 companies, the data is available. This is available in MCA to see. So every department is taking data, capturing data and sharing with the other department. There's a lot of data transmission between departments. Once we are doing a right kind of work, we don't have to be worried, what we have given you. So generally I'll say, hame kya problem hai? We are giving the same data to all set of people. But if somebody is doing it, they have a tough time. They need to understand that gone are those days because GST is capturing the entire kundali of the organization. Who we have sold, how much you have sold, when you have sold. All those information is available. My purchase data is picked up by income tax in my AS portal. So there is, by form of TDS and TCS. So government is trying its level best. It's for us professionals to work with them and ensure compliance in this country. That's it.
But my client is, is a very SME, he just hand to mouth. Yeah. The problem is like, when you recover money from your client, you get 10% less, because of the TDS and all. And, by the time, you recover, before that, you have to pay the GST. So the challenge is the margin, when your margins are, only 10 to 20%, And,
so GST should not be a problem because what you recovered, you are going to pay. Only when the client doesn't pay, we have a major challenge. So instead of the officer calling up and asking, pay it, the officer should tell the vendor to pay in time. If they pay in time, we'll be able to pay it in time. We have no problem. That's the scenario. But having said that, it is only in paper. Somebody has to tell the government that this is the problem. Please help us with this problem. We'll help all other problems from our side. So having said that, the balance sheet has to be prepared as per the format schedule 3, which gives the true and fair view. And we have to understand balance sheet is a snapshot of a firm's accounting value on a particular day, as though the business has stood or momentary still. What does that mean? The numbers in the balance sheet are always a dynamic numbers. If I take the balance sheet as today's morning, it will be different from what I have it in the end of the day because I issue checks, my bank balances will change. I would have purchased, I would have sold, I would have collected money. So when we say balance sheet, that is why balance sheet uses the terminology as on 31st March. That means as the closure hours of 31st March. Whereas P&L is for a period. So whatever is the total sales, total purchases made during the period 1st April to 31st March is there in the P&L. So P&L is always for the period and balance sheet is as at or as on a particular day on the closure of business of that particular day. And balance sheet will always state you what the firm owns, how it is financed. So this accounting equation is a fundamental equation which will never go wrong. Assets is always is equal to liabilities plus stockholders equity. The vice versa is liabilities is equal to assets minus stockholders equity and vice versa. That is why balance sheet will always tally and there is no question on that. When analyzing the financial balance sheet, the financial manager or a person analyzing the statement should be aware of three concerns. We should understand the liquidity concern there. We should understand the debt versus equity synergy in the company and the value created versus the cost created by the organization. Financial statements are used for various purposes. Cash flow statement. Cash flow is a byproduct of your P&L and balance sheet, which tells you how the company started with their opening cash, where all they are funded, where all they are collected, how they have what value assets are being sold, what value of assets being purchased, what loans are being taken, what interest is repaid, what term loans are repaid or any other loans are repaid, and what is the closing balance. So when you see cash flow statement, we have a slide on cash flow statement. It has got three heads on it: cash from operating activity, cash from financing activity, and cash flow from investing activity. It's the operating activity. We have to look keen if you are an operating entity. If you are an investing entity, then it's a different scenario. At the operating entity level, if the organization is able to make positive cash flow, then the organization is doing sound. So we'll get the cash flow statement. Ratio analysis, again, a byproduct of financial statement. Ratio analysis we'll talk about the ratios in the next few slides. Valuation of shares. What is the net worth of the organization based on which solvency certificate is given, based on which your credit rating is also done. So I don't have to give you the definition of assets and liabilities. The only thing I want to specify here is the accounting standard has changed from fixed assets to PPE, property, plant and equipment. The new terminology is used in Schedule 3 now. If you see Schedule 3, it also used the terminology PPE, property, plant and equipment. We don't find the word fixed assets anymore in the Schedule 3. Now the question is, Schedule 3 is a bare minimum requirement. If there is a requirement in any other act which asks you to provide more information, we should be able to provide it. That is the bare minimum requirement. So if a non-disclosure of the bare minimum requirements under the Schedule 3 is a violation, you can give more. And if there is any other law which asks for something, that will override your Schedule 3 requirement. For example, we used to declare the amount due to MSME till last year before this amendment, because it was not mandated under Schedule 3. But MSME Act wanted to show the amounts due to MSME, because under MSME Act, any payables to an entity registered under MSME should have got the receivables within 45 days. The law says 45 days. If an entity doesn't pay within 45 days, then they are supposed to pay everything, I think, twice the amount of RBI rate of interest, if I remember correctly. So that information was mandated under MSME Act, which is being provided under Schedule 3. Now Schedule 3 itself incorporates that requirement. Now, another thing we need to understand when we talk about assets and liabilities in the balance sheet, we talk about two kinds of asset. One is a non-current asset, the other one is a current asset. What is a non-current asset? For that, we need to understand what is an operating cycle of a company. What is an operating cycle? I start with my cash, I buy my raw materials, I convert them into work in progress, then into finished goods. I sell the finished goods and then they convert into receivables, and the receivables converted back into cash. This is an operating cycle. This cycle could be for 60 days for a company, could be 180 for a company, 360, or probably for an organization like real estate, constructing building. It could be 2 years also. The operating cycle, whatever is within an operating cycle, is called a current asset or a current liability. And anything above your operating cycle is called current, non-current assets or non-current liability. But having said that, the laws, generally when we present, we take 1 year as a horizon. So anything which is within next 1 year is a current, and anything beyond 1 year is called non-current assets or liability. We don't have to discuss about owner's equity. In owner's equity, we talk about preference shares also. We talk about your CCPS. We call, convertible debentures. We talk about accumulated profits, everything. I don't think we need to get into the format of balance sheet and P&L. Should we, sir? Or
no, we can skip this.
We can continue, no? Yeah. Then again, I'm not going to get into the details of what is non-current assets. Anything which is not a current. So what comes under the property, plant and equipment, tangible assets, intangible assets, your investment beyond 1 year horizon, all will fall under non-current assets. Anything which is within 1 year, that's your stock, work in progress, debtors, investment, cash and bank balances. If you see the new Schedule 3, the payables or the loans which is to be repaid within the next 1 year, is categorized as current asset because it's going to be paid in the next 1 year. And hence they have brought it under current assets and removed it from non-current asset. So liability is also again the same way, current and non-current. So I've already explained this cycle. What is an operating cycle? Operating cycle is very important. When we think of when we understand an operating cycle, by increasing one operating cycle, the organization can get more profit. So if my operating cycle is say 180 days, if I bring it to 90 days, then I will get 2 more additional operating cycle in the year. If it is 2 more operating cycle, 2 more additional profitability. So 20 could become 30 plus odd percentage of profitability. So that's there in the operating cycle. So balance sheet.
There is one question has come relating to MSME Act.
Yes, sir.
It says even if the terms of payment is 60 days, with
Yes.
the MSME Act, we override the payment of the payment to be made in 45 days.
Yes, sir. That is true. Because when that MSME Act came, one of the big corporates asked, my terms with my vendor is 90 days. Why should I pay with 45 days? Our top management said, stop dealing with MSMEs. No, that's not the case, but MSME Act overrides your normal negotiating terms. But people might be circumventing that, but that's what law says. You have to pay to them within 45 days. Yeah,
Law is very clear. You are supposed to pay 45 days.
Yes.
As you rightly say, people are trying to circumvent, but that is not actually permissible.
Yes. In fact, if you see good corporates like TCS, if they delay the payment by 45 days, they pay along with interest when they make the payment only.
In fact, the company where I was working, whenever we buy from the MSME people, we don't wait for whatever the term agreed, maybe 15 days, 20 days, 30 days, 45 days, whatever, we don't wait. Our management has taken a policy. Whenever the MSME material is received, it is approved, it is due, immediately clear it off within no time. So we normally used to pay within about 10-15 days time all the MSME payments.
So now we have to correlate MSME Act with GST Act. GST says you have to pay by 20th of next month, whatever is the sale. If MSME does not get the payment within time, how will they pay the GST? So law has enabled the provision, but unfortunately, the law also understand large corporates, they can get working capital, they can fund it, they can get working capital loans and do it. For MSME, the provision is there, but unfortunately, it is not, law is there, but in practice, it's not happening. And that's where we have a problem with all these GST not payment and department calling up and say, make the payment and things like that. So there is a gap between the cup and the sip. That's where is a problem.
There is somebody says the MSME, it is a 2 times the bank rate and not the 2 times. Yeah,
Yes.
You're right. The interest payment is twice the amount of the bank rate.
Yeah. Okay. So that's what it is.
Yeah.
So when we look at the balance sheet, the problematic areas, stock valuation, whether it is valued at stock cost or net realizable value, whether it is an obsolete stock, these things will make impact in your financial numbers, your profitability. The importance of debtors and creditors. I might have made a good sales. There must be a profit in my P&L. But if my debtor doesn't pay for 3 years and after 3 years, he goes to insolvency or he runs away, if I'm not able to recover, that means it's going to hit my P&L again as a write-off. So that's where, the red flag items, too much of debtors. If you see again, Schedule 3 amendment, they have said they want the aging analysis, less than 1 year, 1 to 2 years, 2 to 3 years, 3 years and above. So those information, if there is so much of my receivables lying in more than 3 years, then I know there is a time bomb ticking there. It could burst any point in time. So the presentation in Schedule 3 is enabling the stakeholders to take necessary information or understanding of the information and take their necessary actions accordingly. Then accruals, prepayments, and deferred incomes will make a lot of difference in our P&L bottom lines. So if accruals are not made, the prepayments are not being postponed, or not accounted properly, deferred income is not taken in deferred fashion if it is taken in the first year, all these things will have a real impact. We are not talking about an organization doing 1 lakh and 2 lakh turnover. Look at an organization doing in crores, even non-provision for a small amount will have a huge impact, huge quantification. So P&L, we know what is it. We are not getting into that. When analyzing an income statement, the financial manager should keep in the mind financial standards, accounting standards, and accounting policies. As Balakrishnan sir mentioned in the beginning, whether are we following under accounting standards or are we following under Ind AS? Ind AS is applicable for listed companies and certain other company following threshold. So are we following those accounting standards? Not following accounting standard. There is an accounting standard for grant. There is an accounting standard for revenue recognition. There is an accounting standard for investment accounting. There is an accounting standard for each and everything. Whether we have followed, if there is a variation, is it mentioned? And will that variation make an impact in the true and fair view of the organization? Then the auditor has to mention in his or her report in the auditing report. If not,
Shruti wants you to explain what is the deferred payment.
Okay, deferred income, right? Okay. Shruti, I'll tell you, say you have sold TV, for example, and the sales is done with, say, 5 years extended warranty. The extended warranty period, 5 years, maybe they will provide you free spare parts to you. So if I account the income for 4 years in the first year of sale, my expenditure for that spare part will come and hit in the first year, second year, third year, and fourth year. What happened? I've accounted for the income in the first year. My expenditure is accounted in the next few years. There has to be a matching concept, right? For every revenue of income, the expenditure has to be booked. So say, for example, my TV cost is ₹1 lakh. My AMC cost is, say, 20,000 rupees for 4 years. 5,000 rupees, that 20,000 has to be deferred income. That income has to be deferred in the next 4 years. 5,000 rupees in first year, 5,000 rupees in the next year, 5,000 rupees in the third year, and 5,000 rupees in the fourth year. Now, what will happen if I have accounted the entire 1,20,000 in the first year itself? Then my revenues up by, I'm just saying one number. Imagine you put together all your sales. My revenue is up by 1,20,000, whereas the corresponding cost, and these are all, say, comprehensive ANC, maybe one part could itself be costing 20,000 rupees in the next year. My revenue was overbooked in the first year. My cost is booked in the next year, third year, fourth year. So the matching concept is not there. So in such cases, if the revenue is pertaining to various years, it has to be recorded in the respective years. The accounting standard for revenue recognition very clearly says how these revenues have to be accounted for. I hope that answers your question. Is it clear?
Yes, another question has come.
Yes, sir.
Disclosure of related parties as per the AS 18.
Yes, sir.
Is it compulsory to give the disclosure of all related parties, or disclosure names only those related parties with whom there are transactions entered by the company during the year? Actually, AS 18 requires, if you open any of the balance sheet, if you see the disclosure, you have to really say sequentially who are the related parties, including your parent company, subsidiary company, associate company, group company, everybody, irrespective of whether you have transaction during the year, not transaction during the year. Then the subsequent schedule talks about the transaction during the year vis-a-vis comparison the last year. So it is required to be given.
Yes, yes, sir. Perfect. So then non-cash items of the balance sheet items, time and cost. Say, for example, I was talking about the case in the beginning of the session. Nefra debarring a chartered accountant for not providing for interest costs. The bank may not have charged, but interest is accrued on your borrowing. It has to be provided. If it is not provided, it is in violation. So such things have to be taken care. If it is not, your numbers, the final numbers of your profit or loss will not make sense, even if there is one change in any of the accounting policy or accounting standard, or we have not given effect to in the right sense and spirit. So this, I'm not getting into this. Going concern, this is something I want to stress upon again and again. For example, if the net worth is eroded and you know the company has got a problem in continuing, if the going concern is vitiated, how is the numbers in the balance sheet is accounted? They are all accounted at the cost, right? For companies under Ind AS, now they are talking about, I just forget the phrase again. They bring it to the restated value. But if you are doing under accounting standard, it is all accounted at cost. But if the going concern is vitiated, you have to restate all the numbers at the current market value, the net realizable value. Then the entire numbers go haywire here and there. Again, accrual concept, which we just explained about the thing. All these things have to be kept in mind. If any of these elements are not taken care properly, your numbers are not going to make sense. It will not be the true, and forget about correct. It won't be even fair number. Derivatives of profit and loss account, we know dividend is distributed. Your company law talks, how can we distribute dividend? What is to be taken, what is not to be taken, it is there. Managerial remuneration again comes from your P&L numbers. Whether to expand into a particular business or not is taken care from there. Employee bonus is taken care from there. Income tax assessment in your tax provisions all come from there. Let's understand certain basic terminologies. EBITDA talks about earnings before interest, taxes, depreciation, and amortization. It talks about the cash profit or operational efficiency, because depreciation and amortization is a non-cash item. So at EBITDA level, you are talking about the operational profit. Interest and taxes, when you don't remove it, is not a cash profit, but it talks about the operational efficiency. Maybe an organization A and organization B may be making same amount of profit, but B might have loans and they might have interest, whereas A may not have interest on them. So if you want to compare an organization at that level, at an EBITDA level, you can compare them. PBIT is profit before interest and taxes, which talks again about the operational efficiency. When you remove the interest component, we have to understand interest is a tax deductible expenditure. That is why we get the leverage.
Yeah, that is why you said actually the leverage. What is the appropriate level of the leverage by which you can actually get the optimization of your profit?
Correct. So interest is a tax deductible expenditure. Because of the tax deductible expenditure, I get some leverage because of my owner's profit, my shareholders' profit get enhanced. So we need to know what is our optimum level and what is the risk level also we can take. So it is a fine balance between risk and reward. So you need to have your management goal set in and their appetite and the industry in which you are operating. So PBT talks about profit before tax. Again, an organization having some tax benefits, say putting up in some SEZ, or somebody having in some place where they have a tax incentive, they might have a different leverage compared to an organization not getting that tax efficiency. So PBT can be compared before tax and PAT is after tax. From PAT, so PAT is a tax available for distribution of dividend. It could be for equity and it could be for preference also.
Someone is raising a question.
Yes, sir.
Is EBITDA not an operating profit rather than the cash profit?
I just said, and I pull my sentence, because interest and tax is a cash expenditure. So only depreciate. So when we say cash profit, what we do, we take the profit, after tax, add back depreciation and amortization. The non-cash items will be added, and then we find the cash profit. So EBITDA will be able to identify your operational efficiency, because depreciation could be for an organization which is invested in an assets. There could be an organization not investing in the asset, just taken the equipments on hire and doing the work. So at an operation level, if you want to compare, EBITDA is a good level, because if you are profitable at EBITDA level, that means your business model is strong. Only thing, over a period of time, you will be able to recover your interest cost and depreciation and things like that. Does that answer your question, sir?
Madam, where dividend comes, madam?
Yes, I said profit after tax. From there, we minus preference shareholders dividend. It's not interest. It's a preference shareholders dividend. What is left after that is the profit available for distribution to your equity shareholders. That you divide by number of shares, you get the earnings per share. And from that, you can pay whatever dividend you want. Either you pay the entire earnings as dividend, or you want to retain a percentage for your growth and pay only a certain percentage. That depends upon the company's dividend policy and company law requirement, because company law also says in a year you make loss, you can pay dividend subject to certain conditions being fulfilled or removed from your this thing.
Ma'am, where exactly it in the finance statements comes? Where exactly in the finance statements?
Financial statement,
Oh,
if you
it
actually
comes.
look at it, in the profit and loss account, when you have the borrowing interest, it is straight away charged in the profit loss account as the borrowing interest expenditure. It is goes in the P&L account. It is debited as an expenditure. But after calculation of the profit, then what happens is it is actually distributed from the out of the profits, which is available, which is actually nothing but a surplus earned, which it doesn't find a place in a profit and loss account. It is coming actually below the line. Because what is happening is after you arrive at the profit, then you distribute that profit what you arrive. But whereas the borrowing cost goes as the expenditure, which is debited to the P&L account.
And sir, before we used to make a provision for the dividend declared, but now the accounting standard says dividend is provided on a payment basis. So it appears in the next year's statement, whatever is the dividend. We don't make provision for dividend, proposed dividend in the P&L anymore. It is accounted on payment basis now.
Yeah, correct.
Thank you, ma'am. Thank you.
So then equity per share. So earnings per share is a very, very important metric, which tells you whether the shareholder is earning on that particular investment. So if I get an earnings per share of say if my share value's cost is say 10, I earn 1-2 rupee earnings per share. I know I'm earning certain amount of interest, return on that. So earnings per share is a very good matrix to identify whether our investment is making money or not making money. Earnings per share in negative, understood we are eroding. Earnings per share in profit says we have been earning on that particular investment. So I just said cash flow statement is a very, very important statement. Many times we overlook this statement because I said P&L can be window dressed, but ultimately cash, how it is collected and what is your closing cash cannot be, window dressed. So I have to break up my cash flow into operating activity cash flow, investing activity cash flow, and financing activity cash flow. So what is there in my operating activity cash flows? Whatever is to do with my routine regular business, the goods sold, services rendered, money collected on that. So cash sales received from debtors, commissions and fees collected, royalty collected. This will all appear in my inflow. And what will appear in my outflow? Cash purchases, payment to creditors, operating expenses, payment of wages, income tax for operating activity, manufacturing expenses. Please, we have to understand this is all on actual payment basis, the cash flow. So cash generated and spent relating to investment will appearing in investing activity. What is that? I bought a machinery worth several crores. I sold a machinery and collected cash flow. All these information will, I invested in the shares of another company. I invested in my subsidiary company. All these information will come in the investing activities. Say, for example, I'm making loss or negative cash flow in operating activity. I might have financed that activity by selling some of my investment, which is appearing in my investment activity. So I know the loss is being funded by selling my investments or my assets. What is there in investing activities? Sale of fixed assets. This is in the cash inflow side. Sale of investments, interest received on those investments made, dividend received, and working capital recovery. When I say working capital recovery, what is working capital? Current assets minus current liability. If it is positive, there is an inflow, there is an infusion into the business. If it is negative, I have recovered cash from my working capital activity. And what is all there in the cash outflow? Purchase of fixed assets, purchase of investments, and working capital deployment is there in the cash outflow. Financing activity comprises of net flows of cash that are used to fund the company. So my borrowing in form of debt, equity, or dividend paid to my shareholders, all these things will feature. So it measures the movement of cash between a firm, its owners, invested, and the creditors. Net flow of funds used to run a company, including debt, equity, and dividends. So what is all there in the financing activities cash flow? Inflow, issue of shares in cash. Again, we have to understand it's physical movement of cash. If I have converted my, say, debentures or CCPS into equity, it is a book entry. There is no cash infusion. So it will not feature in the cash flow. Issue of shares in cash, issue of debentures in cash, proceeds from sale of long-term, proceeds received from long-term borrowings. This is all in the inflow side. On the outflow side, I have my repayment of loans, I have my redemption of preference shares, payment of dividend to my shareholders, interest paid for my long-term borrowings, and repayment of finance and lease liability. And this cash flow cycle is the operating cycle I was talking about. I start with cash, I buy material, I get some credit period from my vendors, then I pay them, I make my sales, I convert my stock into finished goods and then sell, and then convert it to receivables and collected cash. The cash flow as quick as it's possible is good for the organization. So the ultimate aim of a finance manager should be to reduce your operating cycle time or to shorten your cash flow cycle. So cash flows, yes, sir.
There are two questions are coming.
Yes, sir.
One is someone is asking where the dividend is actually disclosed in the financial statement under the revised schedule 3.
Under revised schedule 3, even I have not seen. I'll come back to you, sir, on that, because you're providing on the basis of payment. I'll come back to you on this. In the next session, when we are talking about schedule 3, I'll come back to you on this. But yeah.
Then one more question is there. Payment of dividend, can it be an operating as well?
Can it be an operating?
I think they are asking operating cash flow.
No, dividend is not an operating cash flow. No, it's nothing to do with your business. It is your financing activity. You took shareholders' fund. That is the investment into the business, and that investment is repaid in form of dividend. So it's a financing activity. It's not an operating activity, nor it is a investment activity. So it's a financing activity. And cash flow is not applicable for mandatory for small companies, 1% companies, and dormant companies. So this is specified in Accounting Standard 3. So this is the slide I was talking about. Some of them we have already touched in the previous slides. Read between lines in the financial statement. My turnover is overstated by not accounting for sales return or recording sales prematurely. My income prematurely. There are milestones to account. I've not completed the activity, but 31st March is approaching. I've booked for it. Or not booking turnover at all. I want to show lower profitability. Booking loans and advances as turnover would be another reason. What are the reasons for inflated or deflated expenses? Expenses are not booked at all. I want to show a profit because I want to bid for certain tenders. Personal expenses booked as business expenditure because I don't want to pay taxes. Excess or short depreciation made. Deferred expenses booked as one-time expenditure. Capital expenditure, purchase of assets are booked in the P&L as expenditure. These things will make an impact in your P&L. Either your profits are overstated or understated. In terms of balance sheet, how the numbers could be distorted. There could be excess receivable. The party might have gone bankrupt, but I'm just keeping for the sake of showing my turnover and profitability. I'll say 3 years down the line, I will reverse that receivable. Excess sales return booked, I want to show reduced turnover. Long time for collection of receivables and invoice cancellation. Movement in loans and advances. There's no movement in the loans and advances from the beginning of the year to the end of the year. In fact, now under Companies Act, you file a form, no? DPT3, any advance given to a vendor for more than 365 days is termed to be a deposit. Inflated, deflated expenses, excess receivables, excess purchase return, long time for payables, invoice cancellation, no movement in loans in advances from the beginning of the year to the end of the year. All these things are problematic areas or which needs little bit of more in-depth analysis to identify whether they are genuine non-movement or genuine numbers, or these are all cooked up numbers or taken for the purpose of either tax optimization or because why I tell you, when I was talking about service tax notices, many of those people who have received service tax notices, they are saying, I don't have the turnover, but I filed an income tax return so that I can get loans from banks. How irresponsible those statements are. Just because I want a bank borrowing, I just file some income which is not even there. And then you come to service tax department and say, these are not my income at all. Who's going to accept those arguments? Gone are those days which will give us, these kind of excuses.
Ranganayaki,
Yes,
I don't know whether you have come across or not. Have you ever come across a company is actually preparing two different versions of the balance sheets and the profit and loss account for the same period? One for the purpose of taking the loan from the bank, other one actually for the purpose of going to BAFR and filing a statement as a SIC companies.
Correct. Gone are those days, sir. Now with all the automation and all digitalization,
Yeah,
thankfully gone are those errors.
because in the past, these are all were happening actually.
Yeah.
There were a couple of company secretaries, there were a couple of chartered accountants who were involved. There have been severe action has also have been taken. In fact, I personally dealt with one of the cases where the company has gone to BAFR, and by virtue of the BAFR, they actually bought instituting any suit for recovering the receivables. I actually went to appellate tribunal of BAFR for seeking a special permission to institute the suit. In the process, when I was going through my homework, I came across the same company has prepared a balance sheet which is showing a much higher profit. They avail the loan from the bank. Then, of course, the consequences are much different. These are all happening in the past when you are talking about, the various ways and means of hiding the things and manipulating and window dressing of the financial statements.
Sir, I would say end of the day, if we professionals stick to our ethics, most of the things will automatically, disappear. There are always bad apples in every industry. So they bring disrepute to us. And when we go to the ministry also, they don't listen to us because there are one or two of us doing that. So it brings bad reputation for the rest of the people. That's where is the problem. I always say in my organization, my boss used to tighten the HR laws. The person who has to run has already run away. The person who are already there sincerely, they will be, pressurized by those new policies. But that's what is happening in form of so many disclosures, so many information presentation, because people like more, all our Vijay Malias have run away. So end of the day, we are sitting and facing the heat of it. So can I proceed, sir? With the
you can proceed. Before that, I wanted to actually communicate to you. Ramana Murthy gentleman is actually complimented you. Excellent presentation by you.
Thank you very much, sir.
One input on the dividend from what I know after the Schedule 3 amendment. So no accounting entry should be passed for recommendation of final dividend by the board.
Correct.
If such recommendation has been made after the date of closing of financial.
Correct. No.
In P&L, the proposed dividend may not affect the P&L. However, the effect of such dividend shall be taken in the year in which it is actually declared by the shareholders in the AGM.
Yes, sir. But
And
the question is, how you present in that year, huh?
And the presentation in the balance sheet is dividend proposed is not a liability till it has been approved by the shareholder. So it should be disclosed at the bottom as a note, like not a note to account anyway it will be there, but it should be disclosed in after note to account. So earlier, it was coming under provision.
Correct.
And now no more. I just thought I just share with you.
Thank you very much. Because we know it is not accounted in the P&L now, because you are not providing for the provision proposed dividend. By the time it is declared, within certain days it's paid. So by the next year balance sheet end also it is not featuring. It's already gone, and that is removed from your reserves, not from your P&L. So it won't appear in your P&L, and your reserves are already taken care of the payment what is being done. So thanks for that clarification.
Yeah, okay.
Thanks a lot for your sharing.
Yes, sir. Thank you. So now let's get into the ratio analysis, which is being asked in the Schedule 3 requirement of from 1/4/2021 financial statement. So see what balance sheet we used to give, a P&L we used to give. There used to be an analysis sitting. They use their own metrics to do trend analysis, fundamental analysis, technical analysis, and your financial statement analysis. And then they used to give recommendation. Now we ourselves give the ratios in the statement. So every stakeholder reading that statement will have an information with them. So the stakeholder, whether it be a shareholder, whether it be an employee, whether it is a supplier or a customer, all of them can make sense and then decide what kind of relationship they want to have with an organization. If the company has got a problem in their cash flow, if I am a supplier giving goods to them, I will stop my credit period. If I'm a customer, then I'm okay, still okay. If if I am looking at another vendor, and then I'll ask for it accordingly. If an employee I'm seeing there is accumulated losses and I see cash flow issues, I might look at another employment. Everybody, government of India will look at from collecting taxes from you. So all those numbers are going to make sense to different people in different ways. So these metrics, whether it is a trend analysis or a ratio analysis, are the barometer of the company. So it is like a thermometer will say 98.4 is normal, above is fever, below is something wrong, but it will not say what is the problem. You have to do further diagnosis to find out what exactly is the problem. It will just give you an indication. So we have to use those metrics, dig deep into the numbers and find out what exactly has happened in the organization. The interesting point is in Schedule 3, this time they have said, if any of those ratios are above or below by 25%, the management has to give a reason for that, above or below 25%. So when a management is asked to give explanation, you will understand, they will also get their perspective in place, what kind of things are going to come in future. So the numbers will make sense and they will become more accountable to your stakeholders. So again, these things help you in interfirm comparison. It helps in a lot of decision making. The analysis could be done in form of trend analysis. So in trend analysis, we can do a horizontal method, say year-on-year comparison, or we can do a vertical method, say 20% of sales is my fixed cost, say 30% of my sales is my interest cost. So we can do a vertical method of comparison, and we can have various parameters such as, it can be compared with sales, GP, NP, profit before tax, after tax. So a trend analysis can be done year on year at an operating profit level, at a fixed cost level, at an turnover level. It can be done in any ways. And the other one is ratio analysis. Ratio analysis is used to calculate the relative size of one number in relation to another one. So it again helps in interfirm and intrafirm comparison. So in interfirm, we talk about our company's numbers with people in the competitors in the industry, and intrafirm is over a period of time of my own company. This will help you to identify the major red flag variances, as I mentioned. What kind of ratios are asked? They are asking about leverage or solvency ratio. What is our debt equity ratio? For every 2 debt, do I have 1 equity? Or for every 2 equity, I have 1 debt. 2 equity, 1 debt, holders are happy, they have money. For every 2 debt, 1 equity people are happy, we are working on external funds. Interest coverage ratio is again a leverage ratio. In terms of profitability, we have a GP ratio, NP ratio, return on equity, return on assets, break-even point, margin of safety. What is break-even point? I'll just stop here to explain that. We must
one more compliment has come to you.
Yes, sir.
Practical aspect relating to the Schedule 3 is very nicely explained.
Thank you,
Good
sir.
presentation. That is
Thank
one.
you.
And another participant, I think Jampunathan is sharing his view. My view for other comprehensive income, in business accounting, other comprehensive income include revenue, expenditure, gains and losses that have to be realized and are excluded from the net income of the income statement.
I said this because there was a question from Prakash.
Yeah.
What is the significance of comprehensive income? So I just wanted to give my view on just as whatever little I knew. Okay.
Other comprehensive incomes represent the balance between the income and the comprehensive income.
Yes. One question, Ranganayaki, is I'm an old mid-80s chartered accountant. So this ratios as at the end of the financial year is still a misnomer for old school of thought like me, because as you know, that people can have a better receivable and inventory asset 31st of March or whatever year end. So my view is that either SEBI or companies, wherever listed companies are there, since there are interim reportings like limited review, and so the analysis should be based on the quarter. That will give a moving average better and also give a judgment whether the business is doing something only in the last quarter in order to collect money or to reduce inventory. And this is my personal view.
I'm coming to that, sir. I'm coming to that.
You're absolutely right, actually. I know there are many companies, they manage the things only at the end of the year, so that what happens that the so-called figures looks very healthier on a given particular date. When the year starts, if you look at it in the next quarter, you realize whatever the company has reported, it's all no longer holding good.
Sir, I will give you an example. In the limited review for the first and third quarter, there is no balance sheet given, right? So when we are asked to certify certain numbers in that for some certification, we ask for the balance sheet copy with the trial balance and link to the schedule. The company will point blank will say, no, I can't give it to you. We don't have a balance sheet. I said, hold on. You are talking to me. You don't tell me I don't have a balance sheet at the quarter ending. You may not have given it to stock exchange, but they are asking me to verify certain numbers. You give me. So there are ways and means, people come up and they think, you will not understand and get rid of that. But sir, having said that, your concern is also understood by Ministry of Corporate Affairs. In the Schedule 3 amendment, they have said whatever stock statement you have given it to the bank, if it is not matching quarter on quarter, if it is not matching with the P&L in your financial number, they have asked us to report the management under Schedule 3, and the auditor is supposed to comment in the CARO reporting. So this is on the
I agree.
stock side is agree. So the regulator is really understanding what is happening in the industry, and as a regulator, they are trying their level best. But it is some people who give advice, ye bhi chalega, wo bhi chalega, manage kar lenge, jugaad kar lenge. This attitude has to go in this country. That's when, because we are sitting in an IBC looking at so many cases, where, public money is being siphoned off. It's been distributed, there are cases in front of us, but laws are able to catch hold of them, that's where is the problem. So
in fact, day by day, regulator is actually throwing upon more responsibility on the chartered accountants. Because earlier day, chartered accountant used to certify, small thing, I'm taking an example. The contract in which the directors are actually interested in the register. In the CARO report, when they are actually certifying, earlier they used to actually certify, yes, all the entries in the register have been verified, they are entered. Now the law requires not only that, the auditors to go to one step beyond and find out whether all the contracts which are required to be entered in that register is really entered and they are correct. So to that extent, the regulator is actually throwing the responsibility on the auditors in every aspect. So it is equally going to be higher responsibility, the auditors part of it before they are certifying it also.
Correct, sir. There's huge responsibility cast. The only fortunate part is when new CARO reporting was given in 2019, the auditor was supposed to, comment on a lot of clauses on which management didn't have any say. At least the new Schedule 3 has included those aspects and asked for the management confirmation. And then the auditor is giving his or her comment saying, whether it is favorable, adverse, or whatever it is. So now the new Schedule 3 is incorporated all the points in CARO into Schedule 3. So at least management takes onus for tomorrow. Management say, I never said that. When we will take one management representation letter, which is of no sense in any court of law. So that's where it is, sir. Yeah.
Yeah, you are absolutely right, because nowadays regulator is coming more and more on auditors' responsibility and also the independent director's responsibility.
Yeah.
And also various KMP's responsibility. With the result, the management is actually supposed to get educated. They have to do the right thing. They have to actually discuss. They have to come out with a better disclosure, and they have to do the right things. That's what it is expected now.
This as a side point, I'll just mention whether we are doing secretarial audit or a cost audit or a statutory audit or internal audit, our audit working papers are our God, sir. We have to ensure our conclusions, our understanding, how we have derived, what we have understood, and what we have discussed with the management and what we have finalized. Because if you go to NEFRA site and see the AQR reports, they are saying there is no link to your comments. And in fact, in one of the comments, they have said there is no discussion paper with the audit in charge with the, the quality in charge of the organization. Audit quality in charge, there is no discussion summarization. So tomorrow, if there is any problem, if we have done our work, we are in a profession. If we don't have working papers, it's as good as we have not put in our effort at all. So our working papers are our ultimate savior, and these working papers make a lot of difference. between an organization doing a good work and not documenting and not doing a good work. So our documentations are our basic thing which will come to our rescue, because again, the intention of the professional goes a long way compared to the accidental slippages. So intention can come only from our audit quality papers. You know,
You are absolutely right, because in fact in the past I came across one particular case. A practicing company secretary has been issued a criminal notice from the magistrate court. You know what is the reason? Reason is he has only certified the resolution where the appointment of the additional director was appointed and the form DA12 was actually filed. On that, people are wondering how that can happen. What has happened is some or other inspection has taken place in that company. When the inspection taken place in that company, while going through the minutes, they actually find the preamble of the minutes actually categorically they are considering the appointment of the independent director. But ultimately, the appointment has actually come as an additional director who is not the independent director. So they actually find out this irregularity. They issued the show cause notice. While issuing the show cause notice, they have included the company, practicing company secretary also as well. The notice has actually come. He has to go and appear and everything and all these things happen. Because as you rightly say, yes, it is not only we are supposed to only see the certification, we are also supposed to see what is the minutes per se. So that point of time, the corrective action, if it is anything wrong, etc., we have to go a little beyond the regulation. We have to do our job. That is required, definitely speaking.
And sir, in how many cases in small companies minutes are there? You just prepare an extract only for the purpose of reporting, and then minute. Thankfully, now directors report ask you to mention how many board meetings have happened and when they have happened. Before that, that was also not there. So these are all the real challenges a practicing professional will find. But yes, we have to work with the system. So then in the activity ratio, we have the operating cycle, debtors turnover ratio, creditors turnover ratio, and inventory turnover ratio. These three ratios will will give you us information. If my debtors turnover ratio is say 5 and my creditors turnover is 8, that means I'm working with a creditor's money. So whether the organization is putting in their working capital or is getting funded through your creditors, these ratios will make, you can compare it with the industry and find out how we are faring in terms of the industry as well. Liquidity ratio, current ratio, quick ratio, because with the IBC experience, a lot of these Schedule 3 amendments have come in with IBC experience, which we'll discuss in the part 2 when we are going to discuss. A lot of those experiences are coming from IBC, and the kind of NPS this banking system has seen, a lot of those disclosure requirements have come from that in the mind of the regulator. They have thought through very well. Only problem is compiling that information with the limited time and the limited fees is going to be a challenge for every professional, nothing more. How we are going to work on it is our this thing. So this is what is the ratio analysis looks like when we start. This is the not the ratio, this is the margin analysis. So ratio analysis, we have already discussed what is it. What are the ratios which is asked in the new company SAC Schedule 3 reporting? The current ratio is asked. First, to understand current ratio, we should know working capital. Current ratio is nothing but current assets by current liability. So what is all in current assets? We just said all the assets which is within the operating cycle is a current assets. When you divide that by current liability, we get a current ratio. So if for every, if it's current assets is say 200 and current liability is 100, I get a current ratio of 2. When I say 2, that means for every one current liability, I have 2 current assets. So that means my recovery is lower than what I'm paying. Again, next ratio which is being asked for is a debt equity ratio. So how do we calculate debt to equity ratio? Total debt by total equity. Total debt means the debt taken by the organization, and total equity is shareholders' equity. Here we talk about preference shares as well. Debt service coverage ratio. This shows how many times the organization has got money to repay that interest and principal amount which is due to the banker or the financial institution. So this analyzes the firm's ability to pay off current interest and installment. Say my current interest is say X and my installment is Y. So X plus Y is my current repayable demand, is my requirement to pay. If I divide that, if I divide the earnings available for debt service, what is the debt services, interest and lease payments plus principal repayments? What is the earnings for debt service? It is the net profit before tax. I add back all non-cash operating expenses like depreciation or amortization because it is a non-cash item. I add back the interest because I'm going to find out the debt service. So I add back the interest and I add back other adjustments like loss on sale of fixed assets and things like that, again in a non-cash item. So when I get that number, if I divide that by my debt service, then I know. So if my debt, my earnings for debt service is say 1,000 and my debt service is say 100, I have 10 times money to service that debt. And that is the interest and the principal repayment. So the organization having 10 will be preferred over an organization having 5 because they have got more, comfort level to give it to them.
In short, it is whether the cash-rich company or cash-poor company.
Whether I'm able to repay it or not. Yeah. The return on equity, it talks about the measures the profitability of equity funds invested and measures the percentage of return generated for equity holders. So how does it work? Net profit after taxes minus preference dividend, because preference dividend is payable preference shareholders, divided by the average shareholders equity. When I say average, it's opening plus closing divided by 2. Whenever we say average, the same thing holds for all these turnover ratios also. Inventory turnover ratio has been asked. So it is a number of times your stock is turned out. Now, sir, concern is, in the end of March, you might have done, it is correlated with the stock statement given to bank. And the inventory they are talking about is average. It is opening plus closing divided by 2. So when I divide cost of goods sold, or if I have only credit sales by average inventory. So when I say average inventory, it's opening inventory plus closing inventory divided by 2 is my average inventory. So how many times I was able to churn my stock into sales? That says in inventory turnover ratio.
Somebody is sharing an information, I think so here. I think it is from Shivakumar. When reading the P&L account, the dividend received from the wholly owned subsidiary company located abroad should be considered while calculating the net profit. Definition of the net profit as per the CSR rules means the net profit of a company as per the financial statement prepared in accordance with the applicable provisions of the Act, but shall not include the following, namely any profit arising out of any overseas branch or branches of the company, whether operated as a separate company or otherwise, and any dividend received from other companies in India, which are covered under and complying with the provision of section 135 of the Act. I'm not able to get it. What exactly in the mind of Shivakumar? Shivakumar, what exactly is in your mind? Are you there?
Yeah, hello.
Yeah.
Am I audible?
Yeah.
Yes, sir.
Yeah. While calculating this net profit for CSR for that 2%, while we see the profit and loss account, there are some amount which is received from wholly owned subsidiary, which is located abroad. So we are calculating based on 198, and we should also, I think, cover the net profit, which is defined under CSR rules. So my question is whether we need to include or whether we need to exclude while calculating that 2%. That is my question, sir.
In my opinion, you should add it, sir, because that's the profitability of your ultimate profitability, no?
Right.
It should be added. But if there is any element of doubt, let's go back and recheck and come back. But on an apparent understanding of your question, that is your profit and it should be included in that.
Included. Okay. Thank you so much. Thank you very much.
Another question has come. Should debt service ratio to be an operating profit ratio where the EBITDA is actually reflect the ability of the company to meet the debt obligation?
I didn't get that question, sir. Can we go back?
Yeah. Should the debt service ratio be on cash operating profit rather than EBITDA to reflect the ability of the company to meet the debt obligations?
We are not only talking about EBITDA here because EBITDA talks only about your operational profit. No, there could be investment from which you have earned income also. That will also form part to service your debt. Say I had invested a certain money in my subsidiary or some other company, and that gives me a dividend, that would also be taken care as a part of my earning, no? So we are talking about net profit before taxes. To that, I add back the non-cash items.
I think here Namita has provided the clarification to dividend. According to her, she says dividend is actually excluded while calculating net profit for CSR. I think we got to go back to the CSR and what exactly the requirement of CSR. That is what I think so. So what Namita says seems to be correct, because the calculation of the profit for the different purposes actually different.
Yeah, what is given in that particular section we need to see. Yeah.
So we need to go as per the section the CSR rule provides, then that is the right position.
Yeah, what is said in the CSR. Perfect, sir. Then trade payables is also calculated. Net credit purchase divided by average payables, that is being taken care. Net capital turnover ratio. Here we talk about the effectiveness of using working capital. So in net capital, we have your net sales divided by average working capital. Whenever we say average working capital, it is opening plus closing divided by 2. And net sales always means sales minus any returns which have come. So that is the net sales. Net profit ratio, we are all very used to this ratio. Net profit divided by net sales. Again, net sales means minus all your sales return. Return on capital employed. This is a very important ratio to understand. At an organization level, are we doing a good work? So ROC is calculated as earnings before interest and taxes divided by capital employed. Here, when we say capital employed, it includes what is capital employed. We remember, we can go back to our study days. When we have a balance sheet, we used to come from all assets minus outside liability, or we start from owner's equity and minus your fictitious assets. So net tangible net worth plus total debt. Here the difference is, because we are talking about capital employed, we are adding back total debt and deferred tax liability. So the higher the ratio means the effectively the capital is being employed by the company to generate returns. So we might use a leverage or anything. At ROC level, it measures the profitability of the capital employed. Here, when we say capital employed, it is the capital of the shareholders plus borrowed capital, all put together, all borrowed loans, all put together, we are going to measure it. This return on investment, I will not get into the ratio. To read it only, I had a difficulty in understanding for a long time. If anybody is very well-versed with it, he can explain it. But otherwise, let me put it simply. Whatever is the return on investment we have achieved from the investments made by the company. This is not talking about at the organization level. I have referred to the guidance note given by CA Institute on this particular ratio. From there, I'm just saying, they are talking about the return made by the organization on the investment they have made, not on the capital they have invested. So if I have invested in shares of XYZ company or into capital of certain ABC LLPs, what is the return I have received from that? How do you calculate the return? Market value at the year end, that is T1, minus market value at the beginning of the year, that is T0, minus whatever is the cost incurred to get this particular investment. So my closing value of shares is 100. My opening was 900. So I made 100 rupees minus sum of CT divided by the market value at the year beginning, that is T0, plus sum of weight of the WT and CT. What is WT? Weight of the net cash flows, and CT is cash inflow. This is a complicated calculation. I'm yet to see anybody who has done this calculation in detail to understand for myself in detail. So this is at the ratio level, as I mentioned in the new company schedule 3 format. They want all these 9 or 11 ratios to be provided. Comparatives for last year, you have to understand, we have to calculate a comparatives for last year also. And if the difference is more than 25% on plus side or minus side, we have to give an explanation to that. The next 2-3 slides are very critical, sir. If you have time, next 10 minutes, I'll wind up.
We have a time, because
yes,
another 10 minutes we have. We
yes,
can take another 5-10 minutes more also.
Because these are practical 3 slides. Otherwise, we can continue in the next section also.
No. If we can close by 1:05, 1:10,
yes,
then
sir,
we have a time.
Yes, sir.
Yeah.
So what are the red flag items we are talking about when we look at the financial statement? High debtors component, high NPA, continuous losses being made, especially when you're looking at group companies, you have to see whether the profit of one company is being moved to another company in forms of, trade transactions. Profit margin erosion, my margin has been, say, was 20% 5 years before, it is, continuously eroding over a period of time. I have a problem. Increase in sales coupled with sales return. So maybe I'm doing for the purpose of window dressing. Continuous cash, or there is a problem in my product or my services. Continuous cash flow issues with increase in sale. My sale is increasing, but I'm not able to recover my cash flow. Then there is a problem. Change in depreciation policies. This is a very minimal thing you will find out in many organizations. You will not find it generally. Sudden increase in staff without any corresponding increase in revenue. Maybe you are preparing for a future project. In that case, should it need for capitalization? All these things have to be thought about. The implication of all these things for a CS in a secretarial audit. When we look at secured loan side, whether it is from banks or financial institution, or is it to be termed as a deposit? And if it's from banks and financial institution, whether the terms of sanctions have been adhered to. If not, then what are the implications of that? Whether it has been brought out in Schedule 3 and brought out in Caro reporting. Is the mortgage being registered as per the terms of the sanction letter? If a company has taken ECB, then have they used that? Is the end purpose as per the RBI guidelines is being met or not? Whether the ECB returns are being filed, because today I find most of the violations under FEMA, it is ECB, not ECB compliance, not done. Every return cost ₹1,00,000. So those non-compliances are there in the balance sheets. Whether FEMA guidelines have been adhered to, has been followed, whether quarterly, half-yearly, and annual reports for ECB has been filed. Deposits and intercorporate borrowings, what implication it has for the organization, that needs to be seen from a CS. Deferred tax liability. So what is a deferred tax? Deferred tax is something, you have a tax benefit under, say, your depreciation under Companies Act could be more or less than the depreciation under the Income Tax Act, because Income Tax Act has given its own depreciation rates. So if the depreciation is plus or minus, they are for purpose of matching, they will balance out. There is an accounting entry to do that. So is that being taken care? Trade receivables for more than trade creditors for more than 365 days. Is it to be accounted as deemed deposits? Loans taken from staff, whether the implications of deposit definition needs to be seen. Loans from NRIs and foreign party, the implications of FEMA and ECB guidelines to be seen. Duties and taxes payable not paid, that needs to be understood. The personal liability or not payment of GST, TDS, PT, small non-compliance, like organizations don't take PT numbers. Now with GST, their PT department is getting that information. So-and-so is registered for GST, they don't have PT number. They send you a courtesy reminder saying that, we find you registered under GST. Please provide us the documents if you have taken PT registration and discharge the liability. Else, please go ahead and do the registration. Late fee paid for various late payment of taxation. Any penalties, prosecution initiated by any department will have an implication on secretarial audit. Income tax payable, long outstanding dues which might affect the going concern of the company. The company might have challenged the dues and they would have put it as a contingent liability as a footnote. What will happen if it materializes? Is the going concern going to be vitiated? Needs to be seen. Dues to MSME, whether the forms have been filed, whether the declarations have been taken, payment has been taken care. Trade payables and other payables to employees, other current liabilities less than 12 months, the implications of that. In case of fixed assets, is the title deeds of the assets are in the name of the company or in somebody's name? This is to be disclosed under new Schedule 3. If it is in somebody's...
Not only that, in many companies, years together, the title deed is never verified. Yeah. And it is doubtful whether title deed exists or not.
So these are the things they want to bring it in light. Benami transactions to be brought in light. Any corresponding loan taken and any charge filing being done. This charge filing, is the most important document, whether we acknowledge it or not. Based on that, there are institutions giving loans. It has to be filed within time, at any point in time. There could be, you could get a time to pay beyond a certain time with the late filing fee, but that will really vitiate the purpose for which it is being filed. So that, whether it is being taken care, borrowing cost, whether it is being accounted, exchange rate fluctuation, AS11 is being taken care or not, depreciation provisions, intangibles, have they been written off, capital work in progress. There is, we'll discuss about it in the next week. Capital work in progress, how it is to be disclosed. Non-current investments, whether the ownership title is again in the name of the company, there is a change in the constitution in the invested entity, that whether that is being taken care. Long-term loans and advances, whether it is properly being accounted. Loans taken appearing in balances as debtors, balances from debtors, that needs to be understood. Debtor credit balances, advances for more than 365 days, deposit implication has to be seen. Bank balances, bank confirmation statement, DRSs, whether they are in place. Fixed deposits, as the certificates are there in the organization. Let's go back to Satyam scandal and understand whether the fixed deposit certificates are there in our hand. Cash payments beyond threshold under the Income Tax Act, is that being taken care? Otherwise, it's going to be a disallowance. It will cost heavily on the tax payable. Where MGT 14 is to be filed on any of these transactions, is that all been filed? In the P&L side, whether revenue from operation, the basic things, when we look at small companies, they must be doing some business. It is not even appearing in their main objectives at all. Whether that is the violation. Interest earned on investment, FCs, whether it's been taken care. Fees paid to auditors for non-audit services, is it being disclosed? From that, can you find anywhere independent of the auditor being compromised? Because this is again an EFRA observation. An organization setting up the internal control system.
Not only that, audit fees paid and non-audit services is separately to be disclosed the balance sheet itself.
Yes, sir. Yes.
Even if it is not disclosed, again that angels is a violation.
Yes, sir. Litigation cost, there must be some, litigation cost from professional fees paid. Will it have a major impact on the going concern of the company? Can be seen, should be seen. Trademarks, copyrights, if they are in dispute, tomorrow it goes away, your entire operation might suffer. TDS not deducted on payments beyond threshold limits. These are all criminal liabilities. Foreign exchange fluctuation, as I mentioned in balance sheet, they have an implication in P&L also. Trade and financial credit notes and debit notes. GST not paid on employees notice paid. Employee leaves an organization, you recover notice paid. Have you paid GST on that? Needs to be seen. Capital expenses debited as revenue and hence profit understated or other way, vice versa. Closing stock over or undervalued, whether in CARO also, in Schedule 3 also, the way in which stock has been monitored or verified is to be mentioned, and the auditor has to comment whether the system in place commensurate with the nature and size of the business of the organization. Data given in the board's report as to conservation of energy, technology observation, foreign exchange earnings, and IOGO, is all these things being correctly captured. Salary paid to staff, is TDS being deducted? ESOP cost accounting, is that being taken care? Is evaluation report being taken? Personal expenses paid by the company, whether it's a part of your employee cost or it is not, whether there are approvals in place. Financing cost, which been taken care, whether charge filed, any delayed pay, whether are you being declared a willful defaulter, managerial remuneration, thresholds being taken care. CSR, when we speak CSR, that itself is a topic for more than 2 hours discussion. Whether that is all being taken care. Depreciation, whether the useful life is being taken from the Schedule 2. Amortization, whether it has been amortized and preliminary expenses are written off. Prior period items and exceptional items are being taken care as per the accounting standard. Tax audit is applicable. If so, is the threshold cross? Is it inclusive or exclusive of taxes? That needs to be understood. Transfer pricing audit, is it applicable to me, whether on domestic transaction or an international transaction? Because in international transaction, even 1 rupee, you are subject to transfer pricing. For domestic, there is a threshold limit of 20 crores. So whether we are following under transfer pricing audit, related party transaction, please take ledger copies and go through the items, item by item, so that any implications could be understood. GST registration to be taken, not taken. Or registration taken, annual return filed, not filed, or annual return filed, but the GSTR 9C, the so-called audit report is not filed. We need to check that. Are the goods falling under really exempt and goods and services? If not, have the registration been taken? If you have exempt goods and taxable goods, if the threshold is beyond the taxable limit, then we have to take registration and do the necessary compliances. GST return for the branches in various states, whether that's been taken, whether they are filing the returns in time. Exports of goods and services is LUT filed with the GST department. And again, MGT filing for all these documentation, wherever applicable, whichever type of company you have, whether it has all been filed. I think it's been a very lengthy session. Thank you so very much for the patient hearing. Any questions, we can take it and
yeah, some more questions are there here actually.
yes, sir.
And here I'll start with the question here. Non-current investment means, can you give some examples?
I said current means anything which is for 1 year. Anything beyond 1 year is non-current asset. Say I put a fixed deposit with the bank with 2 years maturity. It is a non-current asset.
Can transfer pricing and the tax audit fees be undertaken through the statutory auditor?
Not necessarily statutory auditor. You can appoint the statutory auditor as a tax auditor and a transfer pricing auditor. But otherwise, you have an option to appoint another person to get that audit done. Because statutory auditor does only the audit under the Companies Act. And you are free to choose anybody as your tax auditor. And your, if you see, in fact, bigger organizations, the listed organization, their tax auditors are different from their statutory auditor. Because when a person is doing tax statutory audit, it becomes easy to capture the data for tax audit purpose also.
Fixed deposit receipts nowadays are received in the digital mode.
Yes, sir.
Serve as the purposes.
Yes.
Yeah, that it is okay.
That should serve the purpose.
Yeah.
And 31st March, take an account confirmation from the bank.
Yeah. Then somebody is asking a answer to the Shivkumar questions. The current assets only. The current investment means the intangible fixed assets such as patents, tangible assets, etc., equipment, etc. That's what he says. That's all. I think some more compliments have come to you. Thank you for a nice presentation. Thanks very much. Thanks for the very good, fruitful presentation. These are all the compliments which is really coming to you.
Thank you very much, sir.
One compliment is I was really happy to see one slide about the basic fundamentals of bookkeeping.
Yes, sir.
David, I also do this for the last several years. Many people try to mock at me, but
yes, sir.
I guess on the lighter side, it is not about generation, but on the lighter side, if you interview young aspiring professional and you ask them, can you tell me these entries? So one guy told me, sir, मुझे कुछ फर्क नहीं पड़ता, ये तो सिस्टम डालेगा, SAP देख लेगा, Oracle देख लेगा. I said ठीक है, तुमको यदि सिस्टम इम्प्लीमेंट करना है तो क्या डालेगा, तो इसे तब देख लेंगे सर. So I think it's very, very fundamental, because I think I was those days when the first day of CA joining, we used to get the telephone directory to make totaling, and that was the finish at which we had training those days. That was because in olden time, we had to total, and we were told to total out to the second or the third digit. But, very nice. I think that slide was really important, and everybody understand that. I think it will take them a long way. Yes, thank you for a wonderful presentation, Ranganayaki.
Thank you,
really
sir.
Appreciate, and great. I have one topic which I probably talk to you later on the CSR expenditure, in which line of P&L it should be,
yes, sir.
in statutory accounting and in IFRS if you are a multinational company, because in IFRS, operational profitability is what is important, and CSR is not an operational. It is it is an appropriation. Okay, the institute has said no. I don't want to waste the time of others. I will take your expertise on this later. Thanks.
In fact, on that tax deduction also, we have a detailed discussion to be done, sir. We will take it offline and do that discussion.
And TWIP, which now the government has come in, which is very good. Otherwise, people were putting dead investments in CWIP. And now we have to give the aging and also when it will be completed. So that's the great
and the cost overruns also.
Yes, correct. Okay, thank you.
Thank you, sir.
I think with this, we addressed all the question and answer which is appearing in the chat box. There are more compliments which has been actually pouring into Ranganayaki. I must really tell it's a very, very wonderful session as pointed out by Jampunathan. In fact, we can see there are a lot of things you have brought out about the secretarial audit. You have actually enlightened us many fundamental issues. I am very sure, especially the professionals here, they would have definitely got the better insight of the finance, and it is important, and the financial statements, etc. So I think I must acknowledge the receipt, the excellent participation, and the excellent presentation by you, the lucid way of explaining the things very nicely. My hats off to you, Ranganayaki.
Thank you very much, sir.
Speaking. I am really privileged. Even I have learned in today
Thank you very much, sir.
many things in addition to what I know also. That is the thing. So definitely we will continue in the next session, and we'll have more to learn about it from you. That's all. With this, I take an opportunity for thanking you, especially for the wonderful presentation. I also to express my thanks for the participants for their interaction, etc. and other thing and all. There have been questions whether PPT will be shared, whether recording will be available. Yes, whatever the PPT that will be actually shared to each and everybody who are the participant in the registered email ID, and the recording also will be available to you. That's it. Thanks a lot. We end the session with this. Yeah.
Thank you, sir. We are expecting some more presentation in future, sir.
Yeah. Thanks a lot. With this, we close the session. We continue the session next week. Thank you.
Sir. Thank you very much, sir. Yeah,
Thank you. Thank you. Thank you, ma'am.
Thank you
very much.
Thank you, sir.
Thank you, Bala sir, for your moderation. Appreciate.
Thank you. I am also a old timer like you, sir.
Yes, sir. You remember in ICSA, the diploma in corporate governance, for me, you are the.
I know, I recollect.
Yeah.
I recollect. In fact, I worked as a financial controller in a company. And then I moved on as a company secretary. I'm not a chartered accountant, but I'm a cost accountant. And I also done my qualification in the certified internal auditor course from US.
Yes. You know, your old disciple is with us, you know, Sri Krishna Korade.
Oh, I see.
Yeah.
He was actually trained by me.
Yeah. He told me, he always tells, because he reports to me on this thing. So he's a very nice guy. So it's all your mentoring has helped a lot. You know?
No, he is a very, a very shy boy initially who came all the way from Ahmednagar. He was hesitant to even speak, but he had the enthusiasm to do the CS course.
True.
So I have said, nothing doing, you join, you be here with us, you learn whatever the things are there, you will pick it up. Nice boy.
Thank you, sir.
Convey my wishes to him.
Yes, I'm also in Pune only, Balasab. I'll call you.
Oh, yeah, sure.
Yeah.
If you are in Pune, we can meet sometime.
Yes.
Where you are put up in Pune?
I'm in Aund.
Okay. I am actually in Boat Club Road.
Okay.
I'm just staying just opposite to Boat Club.
Take care, sir. Thank you.
Okay. Thank you. Good weekend.